Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of LME 3-month nickel and zinc. I'll start with LME 3-month nickel. 4 weeks ago, the market was moving down through a fairly free zone between the May 2011 high at 27,330 and the August 2011 high at 25,195, when prices jarred to a halt at the round number of 26,000. There then followed 2 weeks of testing until prices gave up on the downside by creating a weekly key reversal up. In the process, the market created a small double bottom and broke back up through the medium moving average, and that's currently at 28,405. However, this move up led to not only a double bottom, but also a shooting star pattern type 1 bearish 3 Mondays ago. Before going further, I would like to explain on a theory I have about why the market halted in the 26,000 area, when there didn't seem to be any sizable support located there. I laid out the basis of this 4 weeks ago and repeated it over the last 3 weeks, including today. It all relates to the August 2011 high at 25,195. This is an interesting level. Other than the fact it was a significant high in the past, it was also the approximate start level from where we had the original huge rally in March and its subsequent ghost highs. Hence, we would be back where the market started, way back in late February, and it is the market's approach to these levels that prompted a premeditated response at a higher level. Indeed, at the next higher round number, and that's 26,000, in anticipation of the very important 25,195 level being tested. Since this very recent move higher, the market started to construct an ascending wedge pattern, currently 29,645 to 32,825. However, this pattern only lasted a week before last week being broken. So I'll retire this pattern after this commentary. Speaking about retiring, I'll also retire targets X and X1 above, targets X in the 3950 area and target X1 in the 32,000 area, related to the primary and secondary targets respectively for the recent double bottom pattern. The primary target was achieved 2 weeks ago, and the market has subsequently sufficiently changed that I suspect target X1 has been passed over in favor of other more recent patterns and actions. So what is happening now? Well, the gapping move lower yesterday, even if it was only a $5 difference, has been the next move in testing the 26,000 level and ultimately the key 25,195 level. Prices closed below 26,000 yesterday for the first time. It's up to the market to see if it wished to exploit that move lower or not. So far, it is a tentative, maybe exploiting it. Below the 25,195 level, we next have the formidable combined forces of the ever so slowly rising long moving average, currently 24,020, and the base in late February build-up of action at 23,865. The tackling of these two will become important, as a little below these we have the target X2, a new target for the potential action of April to date being a possible bearish halfway hesitation. This is in many ways a prospective target below, but it is a potential one should 25,195 break. LME 3-month zinc. There continues to be a lot of interesting things going on here right now. First off, I'd like to set the context. I had previously spoken about how I had on occasion taken a step back and looked at the monthly charts to get a better picture. From these I noted a significant pattern still in operation, plus a second pattern that was forming. The principal pattern was the 2015 to 2020 bullish Andrews pitchfork, and the most recent events involving this pitchfork. Well, 2 weeks ago the market moved up to the combination of this middle time plus the March to May 50% Fibonacci line at 39.96, as well as the then flatlining short medium moving average, currently 39.79, where prices halted, hesitated, and then headed down again, including yesterday. Prior to this, in mid-May, the market had dropped down to the combination of the rising long moving average, currently 35.75, and kissed the lower trend line, currently 35.10, of the second large pattern that was in formation. The lower trend line that was of a very large ascending expanding wedge pattern. After doing this, the market virtually immediately reverted back up again. This second pattern does require some work, as it would require you to ignore parts of March's action, specifically the top of the huge spike on the 8th of March, which pierced but did not close over the upper trend line of the 2020 to date ascending expanding wedge pattern. Anyway, looking at the more recent action, it seems for the moment that the market is capped overhead by the short medium moving average, the middle time and 50% Fibonacci combination, whilst below it is supported by the combination of the lower time and the long moving average. I observe that the lower supports are rising ever so slowly. So what are the forces that are impinging on this market? Well, the recent moves up and now down again still have some other, in one case larger, forces impinging or impacting on them. The larger force is the optimized May 2020 to date uptrend, currently at 38.10, which tries to give an overall bullish aspect to the market, almost a slowly rising bullish angle of attack, even when it has been breached. The second force has not really been tested as yet, though it has seen some market action. Even then, I'm still not sure if it is a valid force. It is the prospective March to April bearish shift pitchfork. The pitchfork has not either this pitchfork has not had either the upper or lower time tested as yet, and until it does, it will remain prospective. The one time that has seen action and has seen an inconclusive response as a result is the middle time, currently at 35.29. Additionally, I can see an argument for a new bearish pitchfork, Andrews or shift, I'm not sure which, but for the mid-April to late May action, but I think it's a bit earlier for that right now. This brings us now to yesterday's action, which was very interesting. Prices dropped down to test the long moving average support and immediately retreated back up, though not far enough to stop another test lower. This placed the long moving average under threat, as well as the lower trend line of the ascending expanding wedge pattern. It may be a two-edged sword, but the middle time of the bearish shift pitchfork could be a support, and if breached, an effective resistance. This brings me to what possible patterns may be in the offing. The action since mid-April to date opened up the possibilities of two patterns that I can see right now. A possible double bottom or a possible bearish halfway hesitation. It's too early on either pattern to see what may be finally formed, but is worth remembering and considering. Finally, let's look at ascending expanding wedge patterns on their own and what they may mean. Well, for starters, they are usually not bullish. Just over half the time this pattern ends up with a bearish break lower. However, if the price breaks upwards, the quality of the move higher is usually seen as better than any break lower. We're not there yet, but with all these possibilities forming and not forming, I thought you would have some idea of what may happen just in case. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright ZD Tofpik and ADM Investor Services International Limited. And here comes the final bit.